Hello everyone, I'm here with you with another topic on Forex volatile currency pairs and their relationship with technical indicators. So let's see what we have. So volatility, what is volatility? So volatility is the price movement or fluctuation or variation of any trading assets. It determines and measures the difference between the opening and closing price of an asset over a specific period of time. For example, a trading currency pair that fluctuates between 10 to 20 pips is less volatile as compared to a currency pair that fluctuates between 50 to 150 pips. Fair enough. And your trading style, strategy, and preference determines which currency pair determines your trading technique. And we can conclude in a nutshell that high volatility in a currency pair, meaning that it's a high risk, and low volatility is equal to low risk. So what are the most volatile currency pairs? We have number one, AUD JPY, Australian dollar. AUD JPY currency pair is considered as a risk measurement tool. The Australian dollar is considered as a risk on currency, that it will be high in demand when there is risk on sentiment in the market. And conversely, on the other hand, Japanese yen is a safe haven currency, and investors move to this safe haven in times of risk off. So that is why AUD JPY is a volatile currency pair. It goes up when traders are in a risk on mode and falls down when investors or traders are in a risk off mode. On the second, we have GBP, Great British Pound, and a Canadian dollar. Another risk on currency is Canadian dollar and gets affected by the fluctuation in oil prices, as Canada is a major oil producing country. And in a risk off mode, and when the oil prices fall, the Canadian dollar can get affected as well. And similarly, the Canadian dollar will see an upsurge during the risk on sentiment in the market when the oil prices fall. So what strategies we can use for assessing market volatility? So how can you harness this question? How can you harness volatility in your forex trading? So number one, there is a saying by Warren Buffett that look at market fluctuations, volatility as your friend rather than your enemy. So you have to find opportunities even if the markets are volatile. So you have to look at the positive side. Number two, you have to use your stop loss orders very wisely. If you set a stop loss level for your forex trade, you are giving yourself extra protection for any market volatility. So that's very important. Number three, how we use economic indicators. As a forex trader, you have to monitor the economic calendar, and by keeping an eye on the major events and decisions that can possibly move the market in one direction or the other, forex traders will be in a better position to determine volatility. So that is very important, and you can find the up-to-date information about the economic indicators on forex factory/calendar. Managing leverage is another important factor in measuring market volatility, and as a trader you need to understand and how leverage works for your trades. The way you use your leverage can increase your wins manifold, but it can also increase your losses as well. So the rule of thumb is that as a forex trader you have to limit the amount of leverage you are using for your trades, and by doing so you are actually putting a risk management strategies for your trades. So managing your leverage is very important. And then what technical indicators we can use to assess or determine or anticipate volatility in a currency pair. Number one, we have average true range. Average true range, or shortly ATR indicator, was developed by J. Wells Wilder Jr. that indicates a true range and displayed it as a 14-day exponential moving average of that particular range. So this is the formula, that this is how we determine average true range. We take current day's high and then minus current day's low, and then current day's high minus previous day's close, and then previous day's close minus current day's low. So this is how we actually determine average true range. So a higher ATR reading indicates higher volatility. So this is how, by applying average true range with these formula and calculations, we can find out what is the ATR value, and if it is high, then there is a higher volatility. On the second, we have Bollinger Bands. Bollinger Bands indicator was developed by John Bollinger that shows whether prices are high or low on a relative basis. And Bollinger Bands consist of three lines, the upper, middle, and a lower band. The middle band is simply a moving average. Okay, the upper and lower bands are positioned on either side of the moving average and are calculated as two standard deviations above or below the moving average. So this is basically how we calculate the moving average, uh, mo moving average and in Bollinger Bands. So the question is how we determine volatility by using Bollinger Bands. The simple answer is a narrowing of the bands indicates that volatility is low, while a widening band shows volatility is high. I have my other videos where I have explained in detail all these indicators, so you can also refer to those videos as well. So this is how we look at volatile currency pairs and what technical indicators we can use to determine the volatility in a particular currency pair. I will conclude here. I hope you like the video. I will see you next time. Have a good day. Bye bye.